Hello, class, and welcome to week 3 of BACC 531 Managerial Accounting. In this week's module, we're going to be covering two very important managerial accounting systems. They include activity-based costing, which is often referred to as ABC costing, and then process costing. These topics, as we'll see, will build directly on our earlier discussions of product costing and managerial decision making, and they're especially important because they help managers to understand how costs are accumulated, assigned, and ultimately used to support strategic decisions. Today's video is going to walk through major concepts that we'll discuss and explore this week. It'll also explain why these systems matter in context of business organizations across a range of industries, and will also help to connect the accounting mechanics that we'll be exploring to managerial decision making and executive decision making paradigms in practice. So we'll begin by examining activity-based costing or ABC systems. Traditional costing systems were developed in the 1800s when companies produced relatively few products and direct labor represented a large share of the total manufacturing cost. Under those conditions, the use of a single plant-wide overhead rate approach based on direct labor hours typically made the most sense. However, modern organizations operate very differently. Companies today often manufacture a variety of products, many different products. They also typically use extensive automation and often incur substantial overhead costs that are not directly tied to labor hours in the way that we've seen historically. As a result, traditional overhead allocation methods can end up distorting product costs. That distortion creates a number of serious managerial problems. Products may appear more or less profitable than they truly are. In addition, pricing decisions may become inaccurate. Companies may unknowingly subsidize one product with another, and managers may pursue the wrong strategic priorities in practice. This is where ABC can become a valuable tool in the manager's toolbox. ABC recognizes that activities consume resources and products consume activities. Instead of assigning all overhead costs one single allocation base, such as direct labor hours or machine hours, ABC systems will identify specific activities that drive costs and will then allocate overhead based on those activity drivers. Examples of activities that are common to this process include machine setups, processing purchase orders, handling materials, customer billing, product testing, and a host of others. Under activity-based costing approaches and systems, costs are going to be grouped into various activity cost pools, and then each pool will use an activity measure to allocate costs. For example, setup costs may be allocated based on the number of individual setups. Material handling costs may be allocated based on pounds of material moved. Production order costs may be allocated based on the number of production orders. The key insight is that not all overhead is caused by production volume alone, and thus the nature of the individual overhead cost pools, those different groups of activities that we're looking at that compose those cost pools or drive them, and thus the driver that serves as the linkage, become important focal areas. When it comes to the hierarchy of activities and how we understand these different pools of activity, one of the most important concepts that underlay ABC systems is the concept of a hierarchy of activities. That hierarchy includes four basic levels. Number one, unit level activities. These are those activities that occur every time a unit of product is produced. Examples could include machine hours, direct labor hours, or factory supplies consumed. With each unit of activity that's being produced, there's a set volume and a set degree of activity that's associated with that individual unit. Secondly, we come to batch level activities. These occur whenever a batch is processed, regardless of the batch size. Common examples can include machine setups, production orders, and material handling. The third category is that of product level activities, and these support specific products or product lines. Examples could include activities such as product testing, parts administration, and product or product design support, the overall design process for different product lines that are being manufactured, or in the service context in areas where ABC can be applicable, different types of services that are being provided or facilitated by the organization. The fourth category we examine is that of facility level activities. These sustain the overall operation itself, and some common examples of these types of activities include factory administration, building maintenance, and security and utilities costs, among others. Understanding these levels, these different levels or categories of activities that drive the broader group of overhead costs, helps managers to recognize which costs are truly driven by production volume and which are caused by complexity. That is, a more complex array of factors and drivers that are ultimately generating that particular pool of overhead. When it comes to traditional costing versus activity-based costing, we will examine in the context of this chapter an example involving Comtech Incorporated, which produces both GPS systems and phone systems. Under the traditional system, the traditional approach, overhead is allocated based solely on direct labor hours. Since both products require the same labor hours, each product receives the same amount of overhead. Under traditional costing, the individual phone units you'll explore in this chapter would receive $40 of overhead, while GPS units would receive $40 of overhead as well. They're both receiving an equal amount or an equal allocation of overhead costs, even though they're two distinct product lines. Activity-based costing, if applied to this example situation described in your textbook chapter, reveals a different story. After identifying multiple activity pools and the appropriate activity drivers linked with those pools, the company calculates separate activity rates for labor-related activities, machine-related activities, machine setups, production orders, parts administration, and general factory support. Once those costs are reassigned using these activity drivers, the overhead cost is going to change dramatically. Phone units, as you'll see, will receive about $97.80 of overhead per unit, while GPS units, after the application of activity based costing, end up receiving about $25.55 of overhead allocated per unit. That's a substantial difference from the traditional approach that gave us the even 40-40 split. What leads to the difference? Why the difference in approach? Well, the answer is because activity based costing gives us a more accurate assessment, a more accurate tracing of how those overhead costs are being generated, and in turn, how those overhead costs are being absorbed, how they're being driven by individual product lines. This difference in the allocated overhead per unit in turn leads to major differences in the calculation of unit product costs. Phone units, as you'll see, will increase from $150 a unit to the more accurate $207.80 per unit with that changed activity-based costing system. GPS units in turn will decrease from a current price level of $110 per unit down to $95.55 per unit as the more accurate cost of production. Thus, one type of product, the phone, is going to increase in terms of its assessed cost, while the GPS units will end up decreasing. Again, it's a classic example of cost shifting and reminds us of the enhanced accuracy that can come from well applied, well structured ABC systems. Traditional systems often overcost high volume products and undercost low volume or complex products simply because of how they're tracing and allocating the overhead cost in practice. ABC, when it's done well, corrects this distortion. Managers then have the ability to make better decisions regarding product pricing, product mix, outsourcing, process improvement, customer profitability, and ultimately strategic positioning decisions. Activity-based management is a related concept that we'll also explore that's linked closely with ABC or activity-based costing systems. ABC becomes useful beyond just the costing process itself and leads to a broader system of management that can be enhanced using this costing approach and the data that flows out of it. ABM, or activity based management, we often abbreviate it as ABM in practice, uses activity information to improve operations by eliminating waste, reducing defects, improving efficiency, and also reducing non value added activities. Managers often use activity rates in these systems to identify areas where costs appear unusually high. For example, excessive setup costs may indicate poor production scheduling. High material handling costs may suggest inefficient plant layouts or facility layouts, and large numbers of production orders may indicate that operations for process standardization could be improved, and thus opportunity exists for greater efficiency if we reevaluate and restructure those processes and those particular procedures. ABC therefore becomes not just an accounting system, but also a management improvement tool that is linked and founded on that costing system. There are, however, important limitations when it comes to ABC usage and implementation. While it offers an array of advantages, it's also accompanied with some significant limits. Implementing an ABC system in practice can be both expensive and time consuming. In order to do it well, companies have to identify activities, they have to create cost pools, gather data to support those decisions, and empower the identification of those activities and cost pools, and then they have to structure the organization and its AIS system in such a way that that system, that is the activity-based costing system, can be maintained over time. And if they're linking that with ABM, that the broader management processes can also be maintained in alignment with that. ABC as a process works best in practice when products differ significantly in complexity, when overhead costs tend to be substantial and thus become a major component of overall product cost, when traditional systems have historically appeared to be unreliable, or when management needs more accurate cost information and recognizes that their overhead cost pools are more complex than the traditional approach is really designed to facilitate in terms of quality or good quality information. Managers must also remember that some costs, in particular facility level costs, may not vary proportionately with activity measures. In other words, there are variations. There are not perfectly aligned flexibilities that exist there, and thus those costs will not always change perfectly in proportion with a given activity measure. So, while ABC in practice can improve accuracy, it's still based on critical assumptions and a great deal of managerial judgment. That doesn't mean it's not helpful. That doesn't mean it can't be a vitally important tool in an executive or a manager or a business owner's toolbox. What it does mean is it's not a panacea. It's not a one size fits all type of solution. And whether or not it becomes appropriate has to be considered on a case by case and a business by business type of basis. As we transition from chapter 5, we will then discuss process costing, or transition into chapter 5, I should say. Process costing is commonly used in industries that produce large volumes of identical or very similar products, what we call in practice homogeneous product manufacturing operations. Examples include things such as oil refining, food processing, the production of chemicals, paint manufacturing, beverage production, and a host of others. These types of product manufacturing environments typically produce very large volumes of the same product on a continuing or ongoing basis. That's distinct from what we've looked at previously when it comes to job order costing systems, which tend to look at individual, highly customized orders that are accumulated and traced on a job by job or order by order basis. Unlike job order costing, process costing will accumulate costs by department rather than by individual job. That difference is crucial because in job order costing, products are customized and costs are traced to those specific customized jobs. In process costing, in turn, production is continuous, units are assumed to be homogeneous, and costs are going to be averaged across large numbers of units. When it comes to processing departments and cost flows related to those departments, a processing department is defined as any unit where materials, labor, or overhead are going to be added to products. Products typically move sequentially through these departments, meaning they move from one department to another department on a consistent, standardized basis, and then the costs are going to follow that flow with the walkthrough of those costs moving from raw materials, of course, the accumulation of direct labor and manufacturing overhead into work in process on a department by department basis, continuing to transfer from one production department to the next until it eventually leaves work in process and ends up in finished goods inventory, and then, of course, will once again ultimately move to cost of goods sold. As you explore this, you'll see that we're using the same basic inventory accounts: raw materials, work in process, finished goods, and then on the expense side, cost of goods sold. But how inventory costs through the manufacturing process are going to move is going to be based upon departments. Particularly, work in process is going to be structured by department rather than by individual job. So, when units move from Department A to Department B, their costs accumulated in Department A are going to move with them. In other words, once the first processing department is done, let's say it's the mixing department, and then this product is going to move forward into a baking or a heat treating department. At that point, all of the costs accumulated in the previous department, that mixing department, they're all going to transfer to the next department where additional costs, that is, additional material, labor, and overhead, will be added to it. That cost will continue to accumulate until the product is complete and then ultimately transferred to finished goods inventory. When it comes to how we assess the cost of inventory through these types of systems, this chapter will focus heavily on the weighted average method of process costing. Under this method, costs from prior periods and current periods are going to be blended together. Equivalent units will be used to measure partially completed production. Equivalent units are one of the most important concepts that we'll explore together in process costing. They represent the number of fully completed units that could have been produced from partially completed units. In other words, if we take all of the manufacturing activity that was incurred and instead of operating on a batch basis, we say, wait a minute, what if I concentrated producing and focusing on each individual unit until it's 100% complete before I move to the next? With all of this equivalent activity, how much could I have theoretically manufactured? To put numbers with that, for example, assume that we have 500 units that are 60% complete. That would be equal to 300 equivalent units. I've got 500 units that are in process, none of which are 100% done. Instead, each of those 500 units are 60% done. If I translate that to equivalent units, I simply take the total number of units in process, 500, and multiply it by the percentage complete, 60%. 500 multiplied by 60% is 300 equivalent units. This theoretical construct allows us to assign costs fairly between completed units and ending work in process inventory. It's important to emphasize that it's a theoretical construct. We're not saying we literally had 300 100% complete units and 200 that we hadn't done anything to. Instead, we know that physically there are 500 units that are in process, each of them approximately 60% complete. The 300 equivalent unit mechanism is simply for the purpose of accurate cost assignment. It will make more sense as you walk through the process in the assignment and in the structure of your assignments this week. But keep in mind, theoretical construct used for accurate cost tracing and assignment. The four major steps involved in process costing, now that we've covered the equivalent unit concept, can be articulated as follows. Step one involves computing the equivalent units of production. Managers must determine the units completed and transferred out and the equivalent units that are remaining in ending WIP or ending work in process inventory. Step two then is to compute the cost per equivalent unit. Total costs are divided by equivalent units for both materials and conversion costs, the combination of direct labor and manufacturing overhead. Remember that conversion costs, as that synthesis of labor and overhead, are, as the name implies, the cost of converting direct materials into a finished product. I often teach my undergraduate students in cost accounting this concept by saying if you're in the kitchen, let's say baking a cake, we recognize that ingredients somehow don't just magically come together to be a finished cake. If you're making a cake from scratch, you need, depending on what specific type of cake you're making, you need some combination of flour and sugar and butter and milk and various other ingredients. Well, those ingredients not only have to be brought together as a deliberate process, either by the benefit of labor, that would be your labor if you're the cook in the kitchen making it or the baker, or by some process of automation, if there's a machine that's simply transferring, conveying those ingredients to the mixing station. One way or another, those ingredients have to have some type of conversion cost applied. If I'm physically gathering those ingredients in the kitchen, my action as a human being doing that is labor cost. Once I put those into a mixer and I start combining them in the right sequence, the cost of that mixer, not just the depreciation on the mixer as a piece of equipment itself, but also the cost of electricity to run it, or in the case of industrial equipment, pneumatic costs or various other types of resources to run those machines. That's also representative of overhead, our second category of conversion costs. Any category, any item of material is going to be transformed in some way or fashion by a combination of labor and overhead, thus why we call it a conversion cost item. Once we have totaled those conversion costs, we then move forward to step three, which is to assign costs. Costs will be assigned to two broad categories. Number one, ending work in process inventory for the period, and number two, units completed and transferred out. If we have inventory that has been, we'll just say, moved into the manufacturing process, it's got to be in one of two places. It's either still in process and thus setting an ending work in process inventory, or it's finished and thus it's transferred either into the next department or into finished goods inventory. Once we've done that and assigned the cost to either ending with or units transferred out, we then come to the final step, step four, which is to prepare a cost reconciliation report. That final report, as we'll see, will verify that total costs accounted for are equal to the total cost assigned, and that reconciliation serves as an important internal control mechanism for managers and executives. When it comes to operation costing, our final major concept we'll treat in this chapter, that chapter will survey operating cost or operation costing, we'll just say on a broad basis. It's essentially a hybrid approach combining the features of both job order and process costing systems. Operation costing is helpful in practice and useful when products share common processing steps and they still differ in materials and customization. Thus, as the named hybridized operation costing approach implies, it's most helpful when you have a type of production setting that sort of shares the features of the typical context where we would see production costing, larger common processing steps, as well as a certain degree of customization that would be more reminiscent of a job order system. It's a hybridized approach between the two. The shoe manufacturing example you'll explore this week in the chapter content and material demonstrates that hybrid approach pretty well. Different shoe styles can use different materials, but the same conversion cost can be applied uniformly across production in terms of that system and that approach. So, as we conclude this week's overview together, keep in mind that both activity-based costing systems and process costing are designed and practiced to improve managerial decision making. ABC systems improve when they're done well, I should say. They improve cost accuracy by recognizing that different products consume overhead activities differently. Process costing helps organizations efficiently measure costs in continuous production environments. As you work through the content this week, focus not just on the calculations, but also on the managerial applications and implications of the concepts you're learning. How do these systems affect pricing and pricing related decisions? How do they influence and empower strategy? How do they improve operational efficiency? And how can managers ultimately use this costing information, this enhanced cost information, to make better decisions? As you explore this content and these materials this week, remember that I will be glad to help and assist you. If you have any questions or run into issues along the way, just reach out and let me know. You can, as always, reach me by email at jake.brock@ucumberlands.edu. With that, I want to thank each of you for watching and wish you a fantastic day and week ahead.